Hello, everybody. This is again the 5th AMR Conference, summer edition of this year. I'm Sandra Wishing. I'm from Biocom, and I wish you a very warm welcome today. After yesterday's session, where we started to discuss about the impact of COVID and the role of academic innovation in that regard, we are today now switching to the financing topic, and I'm looking forward to really interesting discussions with some of the major stakeholders in that space. And I invite now Marc to join from as a moderator. So Marc Gitzinger from Bioverses, and also as a representative of Beam Alliance. He's guiding us through this very first session. So very warm welcome, Marc, and I hand over to you for the start of this session.
Thank you very much, Sandra, and a warm welcome to everyone joining this session today. I think quite an exciting session that we have ahead of us. Should also be, after the introductions, interactive, so please drop your questions into the chat so that we can have an interactive panel despite the virtual setting. Topic of today is infectious diseases in the spotlight and how investors actually evaluate the AMR sector in light of being 18 months now in an infectious disease pandemic globally, and what did COVID actually do for or against the AMR sector. So we have a very interesting panel today, and I hope they can join now slowly. Because, the question that I would then ask during this session, the overarching topic is actually, do we think the glass is currently half full or half empty? Did COVID help us to, get more attention, and also does a slight increase of interest from the investment community into our sector? So I see that Aleks Engel has joined. I think, I don't need to introduce him much, but he's partner at Novo Holding Director of the Novo Impact Repair Fund, and obviously one of the pioneers in coming back into the AMR sector from the investment perspective. Just quickly, can I ask the other panelists to mute themselves, because otherwise we seem to have an echo in the line. Thank you. So Aleks, if I can give you the floor first, and you guide us a little bit through your findings and statistics, what COVID changed in the investment perspective from your research and data.
Thank you very much, Marc. Can you hear me okay? Great. Thanks a million. And do I forward the slides myself, or can I add? Oh, I can. Okay, great. Very good. I will try. And by the way, I am working from my living room today, not because of pandemics, but because of me being based in Boston. So it's 8 o'clock in the morning, and I had guests here, so I haven't made it to the office yet, but it is great to be here with everyone. I see a lot of people on the chat, so phenomenal participation. First of all, as Marc said, I represent Novo Holdings. We're a life science investment fund based out of Copenhagen. We invest on behalf of a charitable foundation. We have about 130 portfolio companies, all life science, all over the world, and we have an initiative to find and invest in novel anti-infective therapies to combat AMR. And also we have put some money into the AMR Action Fund that Henry Skinner represents. We'll speak later, but that means that we are in, I think, a couple of the private push funding initiatives here represented on the slide. Just to remind everyone of the financing environment here, that only about 10 years ago, the environment was very different. We had several blockbusters making, in several cases, billions of dollars, and there was a vibrant venture capital community that funded the best programs. Of course, not everything got funded even then, but of course things have turned quite differently from then. And represented here on the next slide is sort of the public markets view of this, which is that over the last 3 years in which the Repair Impact Fund has existed, those public markets have reflected about a 60% decline, while the biotech index has gone up by about 40%. And also it should be said that over the same period of time, the antiviral index has gone up by about 5 times. So if you had invested in a broad spectrum of antivirals at the beginning of the pandemic without knowing anything about which of the companies might find a vaccine or therapy, you would have made a lot of money. So clearly the markets are paying attention, and they do understand the difference between antibiotics and antivirals with regards to this pandemic. But the pandemic has also shown the strong effectiveness of vaccines, and I do think that area is the first to see a strong turnaround here. We experienced that at the end of last year for one of our 2 portfolio companies that are in the vaccine space. Minervax has a Streptococcus B vaccine that had completed phase 1 with very strong data. And we were able to syndicate a Series B with 47 million euros or $57 million US, which we felt was very strong for the space to fund phase 2. And it should also be seen here that several of these co-investors, Wellington Capital is a very traditional VC looking for returns. And we have a strategic in here as well with Sanofi Ventures. I think this was a very good example of what is potentially happening, at least on the vaccine space. And then I'll talk a little bit about what I perhaps also see for the therapeutic space. But last 2 years, vaccines have certainly seen some interest. We have seen here a number of venture capitalists coming in. You'll see Novo Holdings here with 2 investments, but there are a couple of funds that have put in a lot more money into a lot more deals. And my quick tally here was 35 investments into 22 companies. This may not be 100% accurate, but was a quick snapshot of the deals that I could quickly get access to from public sources. And I didn't actually do the prior 2 years, but I do feel that this is a strong uptick from where we were in the vaccine space before that. So to try to address your question, Marc, glass half full or glass half empty, I think there are elements that weigh on both sides of that. The vaccine side of things we just talked about. We have over the last 3 years seen some deals in the therapeutic space as well. Forge, Roche, 2 Pfizer deals, and we have seen some of these developments on the governmental side that I'm sure we may talk about in the Q&A at the end. I think we're all aware of these bankruptcies that are at the bottom. But the sentiment, and maybe Henry can also talk about this, is I think from some of the strategics that some of us speak with, that would be a lot of the funders of the AMR Action Fund. This pandemic has certainly changed how they do business, and several of them are also refinding the infectious disease therapeutic area to be of higher interest. Some are starting from a blank piece of paper and drawing it up. Others, of course, saying, hey, that's still not for us. But I do think that things are perhaps changing also on the therapeutic space over some period of time. Just a little bit on repair, which is just because I think people are curious how we've been doing. So as you may recall, we've set aside 1 billion Danish kroner, which is about 135 million euros or $165. And we have so far invested in 9 programs. That's about 40% of the fund deployed. We've also already realized a few things, sold a few shares here and there. Overall, we are here at the 3-year mark, down a little bit, but just a tiny amount. And really, that is rather typical for a VC fund at this stage, in that you harvest your losses before your winners. And so I think we are very optimistic that this fund over the longer term is still going to make money. As you can hear from the name, it's an impact fund, which means that we're both looking for financial returns and strategic impact. And we actually believe that the financial impact is perhaps the biggest strategic impact that we can have, in that if we can attract other investors, such as we did with Minervax, then that is really what's going to start setting us towards a more sustainable future. We're also very proud of the impact side of things that we've had so far, in particular since we invest up till and including phase 1. We've had 2 phase 1 successes so far, and that is one of our key measures of success, which hopefully means that people like Henry and others will find such of those things to be of interest and take them further. Just a little bit on lessons learned here over the last 3 years from our side of things. We have been, I think, we've validated and almost embarrassed by the amount of innovation that really exists in the early pipeline. It's truly fantastic, and is just makes the lack of funding so much more of a travesty. Because the commercial market is still very, very hard, and by extension, actually making an investment there is still tough. We think we'll get there, but we've also had the pick of the litter, in that we've been able to invest very, very selectively, where a lot more companies have really deserved investment. So we hope that some of these products are going to get to market and really show that you can make money regardless of the political environment. And then, yes, the vaccine space is definitely picking up. And then, interestingly, we set out to invest in a lot of these novel modalities. And frankly, when we started off, we were a little disappointed in that some of the data from those companies were not quite there yet. But I think from this round that we had for 2021, we are finding that some of these folks now have really the critical data that would be necessary for us to hopefully be able to invest. So yes, the pandemic has raised awareness, and that is translating into some positives, and hopefully also on the policy side. And that's all for me.
Thank you very much, Alex, for this comprehensive overview on the field. I think we go straight to the next panelist and his introduction. So this is David Luci. He's CEO and co-founder of Acurx, one of the great examples that recently made an IPO in this space, and he can certainly share a little bit the feedback from the market and his impressions on, did COVID help? What do the institutional investors think, and how was the experience towards the IPO? Thanks, David, and the floor is yours.
Thank you very much, Marc, and we're delighted to be with you today. Actrex Pharmaceuticals has recently consummated an IPO. We are an antibiotics development company, and we have potentially, so we're on the therapeutic side from Alex's discussion. But on the therapeutic side, we have a novel new class of antibiotics, polymerase 3C inhibitors. And that's important for things like the Pasteur Act and Disarm Act, which focus on companies with new classes of antibiotics that target priority pathogens under the WHO and CDC priority pathogens list. Next slide. So we've raised over $30 million now since starting the company in July 2017. COVID-19 really does bring infectious disease back into the spotlight. We've read that approximately half of the patients who are hospitalized with COVID-19 are put onto antibiotics, which heightens even more acutely the AMR resistance upcoming pandemic, or pandemic as you wish. and the need for new classes of antibiotics to target priority pathogens, meaning those that are resistant and life-threatening. So the challenge for an incubator company like Actrex is to continue to advance the R&D programs in parallel with funding opportunities, albeit them grants or equity investments. Next slide. In terms of framing our IPO transaction, we follow the general parameters. Start with a banker that has the company's vision. Be sure to establish valuation early. It was a 4-month process. We noted during the process that as new initiatives in the private sector and public sector continue to advance, there's less reluctance from the hedge funds and venture capital groups to invest at least in a therapeutics company with a new class of antibiotics that are targeting priority pathogens. There does seem to be some traction with institutional investors, particularly with the renewed focus in the private sector, focusing on developing new classes of antibiotics to stem the tide of antimicrobial resistance as time goes by, and a little bit less trusting in the public sector support, but noting that it's there and it's possible. Next slide. So our IPO was led by 8 to 10 institutional investors. It was 40% oversubscribed, straight equity without warrants, and the valuation does reflect some of the difficulties in our sector of the past. So our goal was to raise enough money to get our lead antibiotic program targeting patients with C. difficile infection through our phase 2B clinical trial, to build on the clinical validation we developed from our phase 2A. And the alternative transactions that were available to us included reverse merger public shell deals. They involved much more dilution and illiquidity. So we were able to avoid those and turn up what we think is a very nice non-dilutive, relatively speaking, deal for our IPO investors. Next slide. So what's next for Acurx? We're going to continue to try to develop our R&D, continue to aggressively pursue funding sources and partnerships, and to support the pull efforts as a member of the antimicrobial working group through Bob DeLucia, our executive chairman. All of these designed to address the challenge of continuing to advance our incubator company R&D programs in parallel with funding opportunities, so that we can deliver value for our investors. We think that the antibiotic sector has bottomed out. We think therapeutics in this sector, anti-infective sector more broadly, will be led back by companies that have new classes of antibiotics that target the treatment of priority pathogens. And that's what we're seeing. We're hopeful that the Pasteur Act in particular can be approved, because we think that would be tremendous for the entire sector. But we're heartened in the meantime by the big pharma companies that have publicly announced their entry back into anti-infectives. And that's Actrex Pharmaceuticals.
Thank you very much, David, for this introduction. Again, my question to be muted, because otherwise, unfortunately, I hear this echo. Thanks. Next up on the panel is Henry Skinner. And of course, the spotlight is a bit on Henry as being the CEO of the AMR Action Fund, the largest funding vehicle now and most important one, I guess, for lots of the mid and late stage development companies. So I guess we're all very intrigued to hear from you, Henry. What did actually COVID do for the AMR Action Fund? Did it help actually the fund in general? Do you have potentially additional interest beyond the known investors into the fund to even increase the size? And of course, especially, when will you start investing in operations in this regard?
Yeah, thanks, Marc, and thanks for inviting me. So I think to answer the many questions there, and happy to elaborate on many. And I think Aleks identified some of the aspects here. So we are operational now. We have the core of our investment team in place. We are open for business in Boston, and we're looking to open an office in Europe in the latter part of this year. And as we grow the team. So we have begun to have discussions with companies. We would encourage people who we might not be talking to reach out to us, and let's get to know each other and put us into the queue. So we'd be very pleased to engage with companies. I think to highlight some things, so, and I think Aleks showed this in his slide, our focus is clinical stage, and I'm getting some echo. I don't know if you're still not, if you're not muted, David. So we are, again, focused on clinical stage. So I would ask if you're preclinical, we'd happy to get to know you, but our investment focus is going to be on the clinical stage, primarily phase 2, phase 3. As our sweet spot as we look to bridge the gap between some of the earlier funding opportunities, such as the Novo Repair Impact Fund, CARB-X and the like, and commercialization and approval. Our focus would be very similar to what Aleks identified as really the key pathogens on WHO CDC list, and looking at mortality and life-saving therapeutics. Very pleased to see new modalities, including atypicals. So we have a broad view there with really a patient-centric examination of the products and opportunities. To answer your question, though, is the glass half full and what has COVID done? I'm not sure if it's half full or half empty, but I think that the direction of fluid or wine in the glass is improving. So I do think that COVID has given us some opportunity. It has certainly highlighted, numerous aspects that I think this community has talked about for a very long time around how small the world is, the spread of resistance mechanisms, and the inevitable increase in the amount of resistance that we see clinically. So I think that has certainly helped. It has helped some broad understanding of what a pandemic can cost to society, both directly and indirectly. And so those are great macro trends that I think benefit the appreciation of the challenges that we've been facing. Nevertheless, the market does remain broken. And as you saw from Alex's slides, the numerous bankruptcies over the last 5 or 6 years have certainly undermined the investment thesis in that we've seen. I do think, and I've pointed to it in vaccines, and previously I had invested in vaccines as well and found it very difficult 5 or 6 years ago. And as you can see over the last 2 years, it has become a very attractive place and gathering lots of investment. I do get a sense in talking with other potential co-investors as we look to invest in these later stage opportunities that there is interest in looking, and it's really our job collectively to turn that interest in looking to an interest in investing by convincing people of the intrinsics of the opportunity, the need, and how the fit of a particular enemy will fit into the clinical paradigm. And that's certainly how we're looking at it. We will be quite active in trying to expand the investment community into this space with people we've invested with before, and really leverage that more broadly. And hopefully the AMR Action Fund is a catalyst for that as we focus with $1 billion under management into this later stage space, that helps build confidence of other more classic venture capitalists and hedge funds to enter some of these investments with us. So I'm optimistic that the level is rising, and whether it's halfway, a little above or a little below, I think the trend is looking quite good. And then what we hear coming out of Europe with the UK's pilot program and Sweden, the G7 and G20 focus, as well as some activity in Washington with the refiling of Pasteur in both the House and Senate of disarm. That if these things happen, I think that's a huge catalyst to bring capital back in. And I think those of us who are leading the effort here will obviously be well positioned to take advantage of that. So I'm optimistic that we're maybe on rising tide, and potentially it could rise fast if some of these things come together.
Great, thank you very much, Henry, also for this introduction. I mean, before we open with the first questions, the panel, let me just also share my view. I actually believe that the glass is on the half full side, because we have seen now increased interest and awareness also from the political side. Also, if I look at our own company, Bioverses, we have actually been able in the last 12 months to raise nearly 50, or about probably even a bit more than 50 million US dollars, large chunk of that from equity investors, and then also in the meantime, efficient financial mix that is possible with the non-dilutive grants like CARB-X, and also from the European Investment Bank, the Infectious Disease Financing Facility. So I think that certainly speaks for an increased interest, not ignoring that the challenges, as Aleks and David and Henry as well, all of us face and allude to. We are still in a very fragile environment where, unfortunately, the missed successes overweigh still and also undermine the investment thesis. And we see that with most of the funding vehicles now being either in the impact sector or looking at smaller returns, certainly, than the classical venture capital model. Maybe to open up the panel, one of the questions I have, we see now is the G7 and G20, this very much probably accelerated in certain countries, also on the EU level, willingness to move to action with pilots and true pull mechanisms. Are we putting all our hopes now on, for instance, Pasteur, and what happens if it doesn't go through? Do you think then all the little seedlings that we have put in place are crumbling and dying off again? Can I give maybe first to Aleks? Yeah.
Okay. Well, I think we are all very much hoping for Pasteur and large subscription models across the world. And certainly some of us are trying to support certain initiatives to make that a high priority with policymakers. And Pasteur and the similar acts that are being looked at in Europe have the power to return the market to what I would call full sustainability, which is that we would be able to get back to almost firing on all cylinders and really progressing the strongest candidates with the market mechanisms that we are all used to, which is to make sure that you get paid for success, and the market essentially will take care of creating the innovation. Absent that, I think I am still hopeful that what we do have in place can keep the car from stalling, at least, and keep it running down the road. So initiative from, and certainly some of our portfolio companies have received relatively large grants from NIAID, from DITRA, and maybe with time, also obviously the AMR Action Fund will come in. And so overall, that is going to create a funding environment which is not sustainable to create what we all want. But we're still going to, in a not subscription model world, we're still going to be able to deliver not as many, but some new anti-infective therapies to the world. And then what we then need to have happen is for at least one of those to become a blockbuster and show that whoever was lucky enough to invest in that thing really makes some money and can hopefully attract some other money. That's the first perspective from me on that.
Henry, can I pass that one on? Because there was a nice provocative statement from Aleks that without a pull mechanism, one of the assets could become a blockbuster. Do you think that's going to happen without a pull?
It certainly can, right? If you go back in time, and I was at Pharmacy and Upjohn, we developed Zyvox. And we projected that would have peak sales of $100 million, right? It ended up closer to $2 billion. So I think if you look at the TPP, the target product profile, you look at the key indications, you look at the need, it is certainly conceivable that you could build a product that would fit into that would return, in that frame. So I don't think we should say it's impossible. It certainly has lots of challenges. I think if we've looked at the recent emergent drugs into the market, we can see from the bankruptcies and their commercial sales that has not been ubiquitous and probably is harder than it once was. But that's not to say it's impossible. And I certainly agree with Aleks. The pull incentives are fantastic if they come about. I think we all need to do whatever we can to help the policymakers clearly understand that the need is there, and that in the absence of that, $1 billion from the AMR Action Fund, the funding from CARB-X, from Novo Repair Impact, et cetera, is a stopgap, right? This is not a solution. This is, if you will, an opportunity for us to keep some activity going. I hate to say it, but $1 billion, as I look at what we need to do over the next decade, isn't nearly enough to support even what we have in front of us. And I would argue that the innovation in this space has been strangled by the lack of capital, or at least reduced by the lack of capital, and hence why CARB-X exists, right? And you don't see a CARB-X in immuno-oncology. There's plenty of capital flowing into that. And ultimately, we need the policymakers to have the changes that reinvigorate that market environment with a combination of successes on our part of delivering meaningful drugs to the marketplace that address the unmet medical needs, and pull incentives so that we have the drugs in advance of when we need them for some of the resistance mechanisms and pathogens coming. You put those things together, I think the AMR Action Fund becomes unnecessary, and there's no need to keep us around. And in an ideal world, as much as I love what CARB-X has done, even better if the market forces provide sufficient capital to really leverage the innovation that we can bring out of academia and biotech companies. So, I think it's certainly a challenging place, but I think we have a responsibility to develop meaningful drugs, not incremental improvements that really change medical care. And I think with that, we've got the best prospects for financial return in the short and long term. And if the pull incentives come in place, these are the types of drugs that are likely to command the greatest returns on the pull incentives as well.
Thank you. I'm just browsing also through the questions from the chat, and I think one was just answered by Henry, saying that, Repair Impact Fund, AMR Action Fund, these are really great initiatives, but they will not be sufficient in the midterm, long term for sure. So we need to get pull mechanisms, and thus also other investors again interested. I would also, some of the questions I see are around, for instance, antibiotics in animals, but also, newer technologies on the microbiome. I would really like to encourage us to focus in this panel really on this financial situation, etc. It is, I think, clear and should be clear also to the audience that all of these efforts that are financed by Impact Fund, by AMR Action Fund, by CARB-X, etc. I think the modern way of thinking of antibacterials is with appropriate stewardship, and obviously also appropriate use of antimicrobials for critically ill patients. So I don't want to digress into these kind of topics, if you allow. Maybe a question for David. You chose now the potentially brave way of the IPO instead of remaining private at this stage of the company. Can you maybe elaborate a little bit what drove this decision, and where do you see the biggest advantages of going that path?
Sure. Thank you, Marc. Can you hear me? I'm unmuted. Hello?
All good, David. We hear you.
Oh, okay, good. Okay, yeah. So we, we kind of let the dilution, kind of lead the way. We had done 10 private financings over 34 months after commencing operations. We had enough resource to do an IPO without having the need for any bridge financing, dilutive bridge financing. On the private side, what we were running into for Series A preferred, which would have been at least twice as dilutive as the IPO, traditional IPO without any warrant coverage. Now, on the private side, the venture capital groups that would otherwise, in an oncology company, for example, may have done a Series A preferred round, would have been more dilutive, but those VCs were less comfortable, those that we spoke with, because they didn't sense at the time, and this is before several of the big pharma companies publicly announced their re-entry into anti-infectives, but they didn't trust that there was a sufficient exit strategy for them. So in other words, normally, if you follow these incubator companies across the board of clinical indications, there's a de-risking model that has been talked about a lot in the news. And what that is these incubator companies de-risk these early stage clinical assets to the point where they get them into late stage trials after establishing clinical efficacy and safety. And then these companies get bought out by bigger pharma companies up the food chain that have sales and marketing infrastructure, thereby creating a win-win for the product, for patients, as well as for the incubator company shareholders. Well, in the Series A discussions that we had, there was a lack of faith that there would be a big pharma company on the other side of our phase 2B and phase 3 program that would potentially be interested to buy up our new class of antibiotics. So without the liquidity of a NASDAQ listing, you faced a dearth of venture capital groups that were willing to take that leap of faith and wind up with what they call dead money in their portfolio, watching a possibly single marketed product company go out and pay the overheads of having one product at market, etc. So the IPO really was less dilutive. It was easier for us to raise the money. And now we've established a liquid trading market so that if we complete phase 2B, and I'm not sure that we would be an $800 million market cap like Summit Therapeutics after phase 2B, but I'm certain it'll be something north of 47 million where we sit today. So our shareholders will have the opportunity to liquidate some of their shares if they'd like, or all of their shares, whatever they want to do, at an appreciated price, and the company would have the opportunity to refinance, say if Pasteur is not passed, to refinance for phase 3.
Okay, thanks. Thanks a lot, David, for these explanations. I have one very easy one here for Alex, and this is if Novo Repair is also looking at Australia on a geographic spot. Maybe that's easy to answer before I move on to some of the interesting questions on valuation.
The answer to that is yes.
Okay, thanks, Alex.
Especially given that there's low COVID and down there. So yes, love to talk.
Okay, thanks. Now, moving on a little bit to valuation. I mean, we had a question, has the ROI perspective or interest changed over the years in VC funds, especially in the AMR sector? I guess the certain question is, thanks to the poor returns, of course, that must have changed a little bit. But I think in valuation, we have 2-3 topics. At the moment, we have, in terms of venture funds, even though its impact was Novo Repair, but also with the AMR Action Fund, we have quite a monopoly, of course. And here, the question that there's 2 questions that come from that. Number one is, especially for the AMR Action Fund, where there was previous investors for the companies that at the stage when you come in now, how do you deal with this to not scare away the last remaining investors in the space, basically by deploying the full power of the investment monopoly, let's say. And number two, we have a lot of non-dilutive funds going into these AMR companies. And how do you look at that on the balance sheet and also from a valuation perspective? Maybe we open with Henry and then Aleks can comment.
Yeah, thanks. So the approach that we take and I take personally is really looking at it holistically. So let's, for at least to start the discussion, put aside the history, because I think you have to look at the company as it exists today, as the programs exist today, and as the market exists today. Now, having said that, the goal isn't to take advantage of a monopoly position and to squeeze the last drop of blood or pre-money value. Rather, it's to make sure that we are structuring a deal and placing a value on it that rewards the innovators, right? Because we need to keep innovating or we're done. That rewards management for the work that they're going to be doing. That rewards the earlier investors, and that lines the company up for success for the next event, right? I hate to say it, but raising money and I think probably everyone knows on the call is job number 1, 2, and 3 as you're moving things forward. It's never done, and as soon as you finish one round, you're eyeing what the next one is, even if it's a couple of years out, and those numbers grow. So as you look at the investment and the value, you really have to have that forward-looking view as well. So how do you raise money today, and how do you raise money tomorrow, and what is the values that make sense to that, and the value created by leveraging that capital into advancing the programs, and making sure that all lines up. And then within those boundary conditions, you have a certain range of valuation. So in an ideal world, that's always up from the previous round. It certainly leverages non-dilutive capital that has advanced programs and created value. But we live in a market that we have to reflect what the next financing need is and the value that we expect to be gained through the investment of the capital between today and tomorrow. So I don't know if that really answers your question, or maybe doesn't do it satisfactorily, but at the end of the day, that's how we look at it. We need to invest in companies to advance the programs and to support the company for its next stage, whatever that might be. Now, that might be an IPO, as David did. It could be, perhaps we'd all be happy if it was an acquisition and fantastic if that's the case, or another private round or a mezzanine round leading to an IPO in 2 steps, whatever the case might be. So all those things have to line up, and that's our goal. So we are not looking to take advantage of a monopoly situation. To the contrary, we're looking to bring in other investors, to broaden what we can do and to enhance the impact we have with our $1 billion by bringing others in as well. Part of that, I think, is going to be, and this gets to a question that was asked in the chat around what was the expected ROI in the AMR space and how has that evolved. I think you answered that, Marc. It's not been appreciated to be high given the notable bankruptcies we've seen and the lack of commercial traction on some of those products. And I think David saw this with the VCs and their tempered look, not necessarily at the science, but at the financial prospects. So we have to remember all of these VCs and hedge funds, every investment they make is an investment that they're not making into something else. So to make an investment in our space with the challenges we see on the macro side, and the failure of some previous companies to realize commercial success and financial success, is they look at it as an opportunity cost. And if they invest in one of us, then they're not investing in another immuno-oncology company or something else that they perceive as having a much greater ROI. So that's the reality, is it's come down, right? The market has told them it's come down. And the other piece that I think is just as important, and David, you touched on this, is the VCs don't want to be in a company that gets to the next stage successfully, advances the program, has successful clinical data, and then has a struggle financing the next step. And then they're left with an asset that scientifically should go forward, financially is struggling, and now you're left to do that syndicate then drive it forward itself, which is a stretch because VCs always like to add more VCs and hedge funds as time goes by, leading to the capital markets. And so that's the other piece to keep in mind, right? We do need to continue to think about that next step. I'm hoping that the AMR Action Fund is a catalyst there in bringing others back in, because with our $1 billion and our commitment into the space, we will carry things forward. So if we finance a company's phase 2B and it looks successful, we're going to be there for the phase 3. And I'm hoping that gives confidence to others who might not come in because they don't know if someone's going to be around for the next step. So I think that's a plus, and I hope that we can bring others in who maybe would be somewhat reluctant otherwise, but like the science and are willing to take a run at a really good program, driving at a significant clinical need that has this potential to be $1 billion win, and we just need to move it forward.
Thanks, Henry. Maybe Aleks, you can take the second part if you want, with the how to deal with the lots of non-dilutive funding in some of the investments from a valuation perspective.
Yeah, good. Well, I think that the addition of the AMR Action Fund and some of these non-dilutive monies really takes a lot of risk out of the equation, as Henry said, to make sure that products can get to market. That was probably the biggest risk that we took when we started the Repair Impact Fund 3 years ago, was to say, look, we could only invest up to phase 1. And so we were very much at risk of programs stranding after that and going nowhere. I think that risk has been greatly ameliorated with the AMR Action Fund, and also what we've seen from DITRA and NIAID and others that are now in BARDA that are investing in some of the clinical programs. So essentially, we believe that the best programs are going to get to market. That still leaves us with the commercial risk that they now, at the end of the day, also have to make money on the market and create an exit. So that risk remains. But as Henry also said, this whole setup that we have today is really to buy us time, hopefully for some of the pull incentives to come in place. And so if some of the pull incentives were to be put in place, not immediately, which would be great, but even in a couple of years, that still leaves some prospects for exits on the commercial side, or at least appropriate valuations for some of those innovative products that may have more niche applications down the road, and at least keep the lights on. And just, I guess, one small aspect of what you're asking is how do investors look at the non-dilutive money? So if a company is able to get $20 million of non-dilutive money, do we value that to be worth $20 million? Perhaps it hopefully should be worth more than $20 million, because it's really unlocking value that would be worth more than that. I think that's what the funders that put in the $20 million are hoping. The reality of the market today is that investors would not value it at greater than 20 million, but it's certainly worth more than zero. And so some 50 cents on the dollar or some number around there is something that I think is very fair.
Thanks, Aleks. I have here one question that I want to at least highlight from Pete Jackson, if I understand correctly. He's referring to discussions he had with the Milken Institute to look at de-risking a little bit the long wait for potential return for early stage investors by some of the pull potentially government funded mechanisms kicking in a staged matter. That's how I understand at least the point, so that an early stage investor, once you reach a certain clinical point, for instance, would start to benefit from a first step of a pull incentive, for instance, and you could get your money back plus some return. I personally think this is a good idea. I'm not sure it's the right forum to discuss it here. It's probably more in the different pull mechanisms that will also be discussed tomorrow. If it's a possibility, it was certainly discussed beforehand. Question is really, again, where does this kind of money come from? And I'm not sure that funds like the AMR Action Fund would look at it like this, because as Henry said, it's more about how do we ensure that the project per se continues to be developable and financeable at this stage.
I'll take a quick stab, Marc, here. So the tiered financing, so creating different risk levels, I think in theory is a very good idea. And venture funds, certainly when we have in various rounds where suddenly people are not participating, there are certain pay-to-play rights and so on. So in theory, we can play with all of this without too much trouble because it's just math. I think, though, that at the end of the day, what I haven't exactly seen solve for is the sort of mezzanine debt type levels that would be at the bottom of that stack. Is how do they actually get anything paid back? So if you're trying to get only a moderate upside, you also need some protection on the downside. And if the company is just going bankrupt because it ended up in a ditch, then those companies don't really end up with much because the assets that are there cannot be sold for much. And so how do you then really create the more protection for those lower level investors? I'm not sure I haven't seen a practical example of how that's been solved for in these kinds of venture stage companies. That's possible for later stage companies, but for early stage companies, I'm not sure that I've seen it at least yet. I'd be very willing to look at it if anybody had such a company with willing investors at the various levels to have a look at it, because I think theoretically it'd be interesting and good to do. But yeah, so we just need to see it happen, and I'd be happy to engage on it.
I would actually like to echo that, Aleks. I think in general the idea is very good, but we haven't seen yet a model that would really, suit or fit the purpose as much. And where is it coming from? Is it governments or whatever? But coming back to the current situation, I think we're already starting to get short on time. But I have certainly one pressing question for Henry that I'm sure that most of my European company colleagues and probably the US ones as well have. When is the AMR Action Fund open for proposals?
Yeah, that's an easy one, Marc. We're open today. So I'll put my email in the chat and be ready to receive people. So we have the core of our investment team in place. We will meet with people, well, virtually at least, and certainly engage. So again, our focus is clinical stage. So if you're preclinical, we'd love to get to know you, but probably premature for us to focus as an investor. And if you're phase 1, coming out of phase 1, that's probably ideal, or in phase 2. So I'll put my email in the chat and would welcome engagement today. We will have a European office that probably won't be open till late this year, but we're happy to engage from the US in parallel.
It's fantastic news, actually. Thanks, Henry, for this great message. So I hope that your email, your inbox will survive. But no, we're very happy to hear that, I guess. Maybe another question. You mentioned the development stage. We heard a lot now also in the discussion around pull mechanisms about novel target, novel modalities versus patient outcome, etc. So, let me be a little bit provocative. Maybe some people that work really on very novel modalities think a beta-lactamase inhibitor is not very exciting. On the other hand, my personal view is, we all developing this not to make the most exciting new thing, but to actually help a patient. So how does the AMR Action Fund look at this balance, let's say?
We're open to both. So We are focused first and foremost on the patient, and at least out of the gate agnostic as to the mechanism if it addresses the clinical need. Having said that, there are pluses and minuses to each of those approaches. If you have another or a new BLI, there's potentially opportunities to that as a class. We know the safety issues. We know what needs to be done. A new modality offers a lot of upside, no pre-existing resistance, perhaps that lasts longer, complements other things. On the other hand, how do you develop it depending on what the modality is? What is the right place for it? What are the sort of broader safety concerns, et cetera? So nothing perfect there other than we will look at each on its own merits and focused on the patient and work our way back and work our way up from mechanism. So we're very happy and eager to look at new modalities as well as classic ones.
Thanks for that clear answer. And I think it's also part of the very successful concept that CARB-X had. They were very broad and open in their approach. And I think this is very good for the field in general. I think maybe the last question towards Aleks Engel, who was running the funds. Do you still think about increasing the size of the funds, maybe on both sides actually? And do you see on the investors into the fund additional interest now since COVID from additional farmers, potentially even outside players that you hadn't had on the list? I also saw on one of the questions, are there impact funds or bonds? How is that looking?
So a couple different questions there. The short answer is yes, we will and are looking to add to our $1 billion. Again, $1 billion over 10 years is just not going to cover as much as we need it to or want it to. That's from expanding our LPs and those who are interested. I think the bond question is an interesting one, a bit different, but an opportunity that should be explored as well. I think impact bonds for a later stage company could be a nice way to provide the capital, effectively growth capital, with a return expectation that's a bit buffered. So I think that's an interesting concept for the later stage companies to contemplate.
Aleks, do you think of increasing the repair fund overall?
Yeah, I think that's a very good question for that I will bring to our board of directors at the right time. I can tell you that if we have meaningful regulatory change, that becomes a much easier question. Yes is the answer. And we'll have to see what kind of impact we can deliver. Both financially and for patients with the first pot of money. But AMR is not going anywhere for a period of time here. So I would hope that that plenty of people, our board and Henry's board and others, would find this to be a meaningful place to put some money regardless of the policy outcomes.
Thank you. And you mentioned...
I'm sorry, Marc, I think I would just add to that. If you look at CARB-X and their history, they've put a lot of good money to work over the past decade. And I think they're up for renewal this year. So hopefully we'll see some news out of them in the coming months that they've been re-supported through U.S. government and Wellcome Trust and others. So I think, there isn't enough capital in this place, and until the market is reformed, I don't think there's going to be. So hopefully all of us can add to our coffers and keep things moving while we get some of these policy changes enacted.
Fully agreed. And if you allow me that comment as well, since you mentioned the CARB-X next funding round, we have here a strong European audience, maybe also some decision makers. I really encourage also European countries and member states or the union itself to increase their commitment or start their commitment into CARB-X. It shouldn't be only the US government and Wellcome Trust. So this is a strong call for action here if someone hears it that can do something. Other than that, Aleks, you mentioned the regulatory change. I think we had also questions to myself and David on this. I purposefully left it out because the time is running short and this interesting financing topic. That's why Please excuse us. Certainly, we need also regulatory improvement and pathways for these newer modalities, but even existing ones in the difficult indications like HAP, VAP, and so forth. Unfortunately, yesterday we had Marco that was unable to join, but we asked a couple of questions, and if they will be answered from him, which I'm sure they will be, I guess Sandra and Biocom will share it here on the platform. And we hope soon to also have, again, the open interaction at this kind of conference with the FDA.
Yes, so Marc, thanks very much for this insightful discussion and also for all the panelists, as you have said. So yesterday we didn't manage to get Marco Cavalieri from AMR in the discussion, but we will follow up with an interview so that he can answer all the questions that arise. And I think we are now at the end of this session, but all the interesting investments hopefully will accelerate. And when we will meet then next year in Basel, hopefully in April, face to face, then we will see hopefully a progress on that side and maybe first investment announcements from the AMR Action Fund maybe. So we are looking forward, or at least to meet the European team as well. So I think this would be a good opportunity. So thank you everybody for this first part of the financing session. So goodbye to you, and then we will open the stage for the next second part.